our approach is built on three underlying pillars. One is that, as Graham says, you want to focus on risk before you focus on return. A lot of it is focused on multiple scenarios. What can go wrong? How much can you lose? We don't think of risk in an academic sense of beta, which doesn't make any sense to us at all. Volatility is not risk. Volatility is volatility. Volatility creates opportunities and isn't necessarily a risk at all unless you absolutely needed to sell the day that the price was very low. Rather, risk is the probability of losing and how much you can lose if you lose. So we focus on risk before we focus on return. That's obviously very different from Wall Street, where they still, even after pressure, write a huge percentage of research reports that are bullish, very few that are bearish. And even when they do think about other scenarios, they tend to oversimplify with single point estimates rather than a range of possible outcomes. And in other words, inevitably are focused mostly on how much you can make, and with a spurious precision. Now, the second underlying principle that we think about is the world is oriented towards relative performance. It's one of the giant weaknesses in the investment world. All the big mutual funds are focused on competing against each other, competing against the market. So they're looking at relative numbers. If the market's up 20, they want to be up 21. If the market's down 20, they want to be down 19. The reason for that, by and large, is everybody's an asset gatherer. And when you gather assets, if you perform in the top half of performance, or if you avoid the bottom quartile of performance, you almost certainly never get fired, you don't lose clients, and your firm is very profitable and successful. So by contrast, we think wealthy individuals and established institutions, because of the risk aversion, are actually interested in absolute returns. That in other words, if you're focused on absolute returns, the idea of losing people's money becomes fairly abhorrent. And if you focus on relative returns, you're happy with losses as long as you lose less than everybody else. So the relative approach ends up forcing people into a kind of a closet indexing approach, that you don't want to look very far away from the indexes. You don't want to look very different from the indexes, because if you underperform by taking a chance at being different, you could lose a lot of your assets under management. So you end up kind of tracking the indexes and lying very close to them, which basically gives you insured mediocrity, that you won't severely underperform, but you won't outperform either. Our view is that the idea of sending a letter to a client, dear client, the markets were down 30%, we were down 28%, would make us sick. That your goal is not to lose less. Your goal is to kind of try to make money all the time, protect capital on the downside, and still do well enough on the upside. The third part of that three principles is the importance of being bottom up and not top down. Most of the investment world has a top-down orientation. They think about how's the economy going to do, and how our foreign currency is going to do, and what are interest rates going to do. And I'm not saying that stuff's totally extraneous. You certainly want to think about it, but you analyze investments bottom up one at a time. Top-down investor like George Soros in his heyday would have a view that the pound is overvalued or undervalued, or that the Fed was going to cut rates or raise rates. And that would drive your decision-making and lead you to specific areas of investing and then specific companies within those areas to try to take advantage of those themes. And my view is that is incredibly difficult to do. I don't know anybody with a really good long-term demonstrated record of success with macro forecasting. And beyond that, you not only need to be incredibly good at the macro forecast, you need to translate it correctly into industries and companies, and then be early, or the prices may have already moved to reflect your viewpoint. We think the biggest edge any investor can have, and the biggest edge we do have, is a long-term orientation. And it's easy for people to say they do, and it's harder to actually have it. One thing that's really hard is, in a world where people are comparing your results often, where a short-term underperformance might truncate your ability to take a long-term approach, the ability to actually have long-term oriented money, and that's why we only have wealthy families and institutions. We don't have fund of funds, we don't have sovereign funds, we don't have pension funds, we don't have public mutual funds that we offer. We only have this long-term money that is able to take that approach, and quite sophisticated money at that. in today's world especially, you can see how clear it is that a fund that's down 25 or 30 or 40% has almost no ability to take a long-term approach because, like most funds, they're getting redemptions. Even funds that are up are getting redemptions because clients need their money back. And how do you make an investment decision for a 3 or 5 year hold when you don't know if you'll have that capital for even 6 months? So a lot of funds feel this enormous pressure to either hold cash or to buy very short-term situations, bonds maturing in 3 or 6 months, stocks that have a catalyst that will work out almost immediately. And that leaves a huge swath of the market with much less competition than usual. So long-term orientation is critically important. Yeah, we never hold on for the last nickel. I think you make a big mistake when you do that. First of all, we never assume something will go past its fair value. A lot of times people will fall in love with something. They buy a stock at 10, they think it's worth 20, but it's acting so well when it hits 20 that they hold on till 25, and it's no longer a value at all. Not that you shouldn't reassess if you decide, it really has added value. Their business is better than I thought. Their retained earnings bring the value higher. That's okay. But to just fall in love with it because it acts well is irresponsible. One of the things we try to think a lot about is this business is largely about psychology, that if you're down a huge amount, you're not thinking straight. If the markets do something that completely surprises you, you can be a deer in the headlights. Right now, many firms are not willing or able to commit capital, even if they have cash sitting there, because they're afraid of redemptions. They really badly don't want to be down again in 2009. They face an ongoing task of getting back to high water. So that is a huge. It's a huge benefit to not have your own psychology get interrupted. The example I like to use, let's say again, you find a stock at $10 that's worth 20. If that stock goes to, let's say, 18 and a half, we will have sold it. We'll be gone. And we'll let somebody else make the last dollar or two. And part of the reason is you want to encourage a buyer to be there to buy it, to make that last dollar or two. If they're not there, you may not get it, it may not go to that level. So if you hold out for 20, you might never get to sell. But forget that. If we sell it at 18 and a half, and then it shortly afterwards announces terrible earnings and the stock plummets back to 10, how do we feel? First of all, I feel pretty darn good that we sold it, took our profit. Second, we think we got another chance to get another bite at this apple. We think it's worth 20 still. Let's say we reanalyze it, we verify it's still worth 20. We can invest at least as much, maybe more, because now we know it better. We like management. We're comfortable with the business. Now, let's say we didn't sell any. We were greedy. We're holding out for 20. We're so annoyed. We're annoyed with ourselves. We're being human, we don't really admit that. So we yell at the analyst. We yell at management. Those idiots, why didn't they tell us it was a bad quarter? And it goes back to 10. And at best, you hold on. And at worst, you hate them, you sell it, you certainly aren't adding because you've been burned. So that psychology of the round trip, if you will, is devastating. So we always, for a whole variety of reasons, including also some of our positions are less liquid. They're small cap companies or we own 10% of the company. And you need to sell that. A friend of mine refers to it as feeding the birdies when they're hungry. You need to sell that stock on the way up. On the way up, there's volume. On the way down after bad news, there's no volume till it opens down 30% or 50%, and then there's volume, but it doesn't do you any good. So we'll always sell too soon. We'll always buy too soon, and hopefully we'll make money somehow in between, nevertheless.